Welcome back to a brand new video. Today we are going to be discussing the direct and indirect impact on the housing market from the war in Iran. If you're new to the channel, my name's Ian Phillips. I'm a realtor in Southern California and I upload weekly videos diving into specific markets as well as talking about the more broader economy, as all of this has impacts on the housing market. So let's get straight into it. So we're going to be discussing two main topics in this video. That is the direct and indirect impact that this war is causing on real estate. And one of them is obviously sentiment. Sentiment right now is pretty fearful, caused by the fear of unknown. A lot of people are relating back to historical conflicts in similar regions and pointing out the fact that they have lasted years. And because we are only 1 month into this conflict or war, it's really uncertain how long this is going to last. So that has caused a lot of fear and really people not knowing what's going to happen, and the stock market has had a direct impact because of this fear. The other thing we're going to talk about is the indirect impacts, such as oil skyrocketing, causing fears of inflation coming back, and that having an impact on mortgage rates, and if the Federal Reserve is going to be able to cut rates multiple times in the second half of this year like they previously anticipated. So we're going to be looking at all of this data and really giving my perspective on what's been happening in the housing market. I've had a lot of people ask me this question over the last week or so I wanted to make a longer video going into depth and discussing this a little more. So let's get straight into it. So first off, we're going to be looking at mortgage rates. And as you can see, mortgage rates are now back at 6.5%. Now, for reference, this is the day before this war started, February 27th, where mortgage rates were at 5.99%. And you can really see over the last year or so, they were on a downward trajectory. And my personal opinion is I was expecting mortgage rates to get back into the mid fives by summer of this year. Clearly, that is not going to happen anymore unless this war is resolved within the next couple months. You can see this was on a really good downward trajectory. And immediately after this war started, they skyrocketed. Now, the reason this happened is because a barrel of oil went from like $70 a barrel to over $100 a barrel in a very short period of time. This has caused fears of inflation coming back, and the Federal Reserve really questioning whether or not they should be cutting rates in the second half of this year, because oil going up is pretty inflationary. If you think about everything that we import into this country, it is coming on a container or being flown in. And if the cost of bringing those goods in is increasing by 35% in a matter of a month, it's more likely that those goods will also increase in value, in cost to the general consumer. Now, it might take a couple months for this to show up in the data if oil remains at $100 a barrel, and that will likely not be seen until potentially end of April or May in the consumer inflationary report. Now, if this conflict is resolved within the next month or two, then potentially oil drops back down to $70 a barrel, and we only briefly see a direct impact in consumer inflation as well as overall inflation. So that has been the indirect impact on the housing market. Mortgage rates increasing by 0.5% definitely will impact a lot of first-time home buyers, because if you're sort of on the border, on the cusp of being able to afford your entry-level home and mortgage rates jump by 0.5% in a short period of time, that is obviously going to impact your affordability, particularly if you're doing 0 down, 3.5% down, 5% down, 10% down. Mortgage rates jumping by 0.5% definitely have an impact on that. Now, obviously, cash buyers, investors who are doing 50% plus down, this probably won't impact you too much, but what may impact you is the direct impact of fear. You can see the fear and greed index. This is as I'm recording today in the first week of April, is still in extreme fear. And this obviously has an impact on overall sentiment. This has impacted the stock market. It more recently had a 10% drop. Now, at the time I'm recording, this has rebounded a little bit. You can see the S&P 500 is up 2.6%, but still the market is in extreme fear. All of this does translate to the housing market. If you think of your first-time home buyer or any buyer in general who's potentially about to make the largest purchase of their life, and all of a sudden the market is dropping, people are in fear of uncertainty. Again, we don't know how long this war is going to last. History has shown us that conflicts like this could last years. So it wouldn't really surprise me if you have some people in the market just taking a step back, wanting to sort of see how this plays out over the next few months, and if there's any sort of resolution, or if this is going to be something that lasts years on end. Remember, the stock market dropping has a direct impact on the housing market. A lot of people are using the stock market as a way to put their down payment into the home, into their first home that they're going to buy. And if the stock market drops 10% in a matter of a month, that has an impact on buying power. For a lot of people that I have represented buying a home, their entire down payment was in the stock market. And when it's doing well, that gives you a little more confidence to start writing offers, because you have a larger down payment going toward a more safer investment, a more longer term investment, such as your home or an investment property. So that is the direct impact on the housing market. When people don't know what's going to happen, when investors don't know how things are going to play out, it creates fear, it creates uncertainty. Now, going back to mortgage rates, I want to talk about the Federal Reserve cutting rates, because prior to this war starting at the beginning of March, end of February, we had the expectation that we are potentially going to get a rate cut as early as June of this year. That is when the chairman of the Federal Reserve, Jerome Powell, is likely going to be switched out. And a lot of people were anticipating, a lot of investors were anticipating that the new chairman would likely start cutting rates sooner rather than later. So as of right now, the Fed's interest rate is between 3.5% and 3.75%. And for the April meeting, there is a 98% chance that the Fed is going to remain at these interest rate levels. In other words, they are not going to cut and they're not going to raise. And there are currently no odds that they're going to cut. In fact, there's a 2% chance that they raise interest rates. Scrolling down to the June Federal Reserve meeting, what are the odds that they do anything here? Well, there's a 91% chance that, again, interest rates remain the same. Only a 7% chance that rates are cut. Remember, prior to this war breaking out in around middle of February, the odds of rate cuts happening in June were actually substantially higher than no rate cuts at all. Let's see what's happening in the July meeting. An 85% chance that there is no rate cut, and only a 12% chance, 13% chance that the Fed is going to cut rates in the month of July. Again, prior to this war, there was basically a 100% chance that investors were pricing in a rate cut in July of this year. So think about that for a second. All of a sudden, investors, literally within a matter of a month, have gone from pricing in multiple rate cuts happening in the second half of this year to now no rate cut happening in June or July. So this has had an impact on mortgage rates and overall affordability. And again, this is also impacting sentiment around the housing market. Remember, the consensus was we were going to get multiple rate cuts in the second half of this year. And all of a sudden, this has been taken away from us. So what about September? In September, there is an 85% chance that the Fed is not going to cut rates. So the same as July. So we've gone from pricing in a rate cut as early as June to now no rate cut in June, no rate cut in July, and no rate cut in September, which is the third last meeting of the year for the Federal Reserve, and only a 13% chance that the Fed cuts rates by 25 basis points. So as of right now, the odds of no rate cut happening in the second half of this year is almost guaranteed. Now, I will talk about the potential optimistic view on mortgage rates and the housing market shortly, but let's go ahead and look at the October meeting. 81% chance that the Fed does not cut rates in October of this year. 81% chance. We were going to get potentially 3 rate cuts in the second half of this year, and there's only a 16% chance that the Fed cuts rates. What about the December meeting, the last meeting of the year? 70% chance that the Fed is going to hold rates steady and not cut rates at all this entire year. That is a drastic change from what investors, consumers were anticipating just a month ago, 6 weeks ago. Sentiment has changed massively over what everyone is going to expect, or what everyone is now anticipating in the second half of this year. We're basically, as of right now, we're not getting any rate cuts in the second half of this year at all. Because even if you go back to the last meeting of 2026, there's still a 70% chance that the Fed is not going to cut rates. Now, I do want to talk about the optimistic view a little bit before I end this video. So when we look at what mortgage rates have done over the last month or so, we can see that they very quickly, in a matter of 30 days, went from 5.99% to 6.6%. All caused by the war in Iran, all caused by oil skyrocketing, all caused by expectations that inflation is going to come soaring back because oil is now at $100 a barrel. So if there is some way that this conflict, this war, has some sort of resolution as quickly as how it started, then there is a possibility that oil crashes, mortgage rates also drop because oil has crashed, and those fears of inflation start to dissipate. Then we could potentially get back on this trajectory of mortgage rates going down. So that is the optimistic view on where mortgage rates will head in the second half of this year. My personal opinion was that we were going to see 5.5% by summer of 2026. Obviously, that is likely not going to happen unless my optimistic view plays out. Because of all of the economic uncertainty and this war that has played out for really the last month or so, we really just need to wait and see what happens. And that's probably what the Federal Reserve is thinking as well. They just want to wait and see. That's why there's no more rate cuts priced in at all this year. The Fed is thinking, well, oil's now at $100 a barrel. This could potentially cause inflation to come back. Why don't we just wait and see if it actually shows up in the data before making any decisions on what we do with interest rates? So they're obviously in wait and see mode. They're going to have to react to the unemployment rate, which is another factor, probably an entire video that I can make separately. But they react to the unemployment rate and inflation. Unemployment has been trending higher slightly, and inflation is really in this unknown scenario where it could come soaring back due to oil skyrocketing, due to this war that has broken out. But that's going to be it for the video. If you have any questions, let me know in the comments below. If you enjoyed this video, subscribe for more, and I'll see you next time.